The environment we're in has a lot of opportunity if we're willing to look at it in a different frame. So one of the things I believe is I believe that we can look at the charts. Mark has talked about it already. I believe that we have put in a significant high and a significant low. Both of these highs and lows are strong enough to be the high for the year and the high for the low and the low for the year. So it's quite possible the high and low for 2025 is already in. At minimum, I think it's the kind of high and low that could carry us all the way through into September, into the fall before they break. So we'll look at some examples of that to talk about that. But we step back for a moment and we say, okay, we're in an environment where we know for the high of the year is in and the low of the year is in, and it was kind of violent on both sides, particularly on the low. Well, then that leads us to an environment where we're going to have declining volatility. And I think there's a number of trades that can be done where we can be strategically long, but we can be short a lot of volatility against it, such that if we get these slow grinding moves, we get these moves up to resistance that pause there, we can do really well on those without making new highs. And we'll talk specifically about some strategies that we can use to be able to maximize that. All right, when we look at the month, because we have these ranges, and I think we put in a significant low, I think we're in the process of oscillating all the way up. And I think we're going to make a run at the highs from this year. But there's a lot of resistance up in there. So even though I think we're going to go there, and I think that might get a lot of people excited, I don't think it's going to break through. Now, anything can happen, but just based off structure, that's what I think is going to be the case. The gold theme, which is still a very valid theme for all the reasons that Mark said, but it was also gold is very interesting. Mark will talk a lot about how when you're in a gold theme, you have to be willing to take some pretty significant drawdowns. And he's right. And what we saw in April is really a good example of that because the gold basically ended up being kind of a mix of two different things. It's a theme. It's a strong trend that's been going higher, higher, higher. So that's good. And it was also a risk haven. So in the mix of all this, people were rotating heavily into gold, but then soon as all this looked like it started to slip away, it started selling off. And that was something earlier in my career I didn't always understand. So a lot of times when gold would really start to take off, I would load up. And I was loading up in a risk off situation. And then something would come out and everything would reverse. And I would stick to my guns that gold is in a really strong run and I should stay with it. And honestly, net, I've made a lot of money in gold. It's one of the things I've made the most amount of money in over the years. And having said that, I've had some of my biggest 1 day, 5 day drawdowns in gold positions going from risk off to risk on. And that's to me essentially what we had in April. So the theme is still in place. I think we've carved out a big range. The question is, what is the bottom of the range? I'm not sure entirely if we know that yet. We'll look at some charts to talk about that. Mark spent a lot of time talking about tariffs and talking about trade deals. I did want to mention this was something that's very interesting. This is in Zero Hedge over the weekend, and they talked about that China has quietly started to exempt basically about 24% of U.S. goods from tariffs. So China tends to talk big up front and then do things behind the scenes that they'll never acknowledge. And this is an example of that. And conversely, as we know, the Trump administration started exempting smartphones and other electronics. Again, in kind of a back channel, one, to help U.S. companies, but two, in back channels to try and start and put a trade deal together. There's also been serious discussions about fentanyl. The Chinese have come to the United States and essentially asked them, like, what do you specifically want us to do about the fentanyl trade? And that is also, in some respects, a pretty big step. One of the things that was mentioned in this article is that ethane China buys 76% of the United States ethane, and that this is a big, big problem for them if they're not able to buy it from us. Like we think a lot about the rare earth minerals that we try and get from China, but this is a flip side to the equation that they really need ethane from us. So that's also something very interesting. And Mark is right. The U.S. media is not doing a good job. Imagine that of showing what's actually going on in with these tariffs and with the trade deals and so forth. And if you read the press, it's all about how bad this is affecting us. But the reality is, I think it's going to affect China more than us. And I think these are some of the examples. Okay, so when we look at May, I want to go in and we'll look at some specific charts. But we've got these strong lows in place, which we'll go look at here in a moment. But the big thing I want you to think about is I think we're going to range trade. I think we're on an upswing, that this upswing can carry us a decent amount higher. So what do we want to do? To me, if you have names that you like, if it's a stock that's making new highs, this is a different story. To be clear, we're not talking about stocks that are making new all-time highs. We're talking about stocks that have been historically strong, that are still have underlying strength, but are probably locked in a range. And this is basically like Mag 7, right? This is NVIDIA. This is Tesla. This is Microsoft. This is Google. There's only a handful of these big names that have really been able to break out. Netflix. I mean, Netflix is just launched. But the rest of these, they really look like they're confined in a range. So how should we trade these? One strategy that I really like to use is what I call a targeted straddle. A targeted straddle is basically where you sell. Everybody knows what a covered call is. In a targeted straddle, you sell two calls, not one. You sell two calls against the stock. And then I typically buy one upside call for defense to defend the unlimited risk on the upside. So I manage the trade as a long with an exit below. I'm short two calls above, and these calls are heavy. I typically strike them near where the resistance level is. And if we get the move where we rally into them, these calls are going to get the volatility sucked out of them, and they're going to start to go towards zero as you're rallying. So you set yourself up in a position where you make money long the stock and you make money shorting the calls. I like this strategy a lot. It collects data. It benefits from a collapse in volatility. If we sit in a range, you'll make money when you're not doing anything. You even make money when you break some days. So that's one example. Now, the downside to that strategy is that if we get some kind of shock, you're going to have to get out. And you're going to have to manage it. It's like any other position with the stop. You're going to have to get out. And if you have a gap or some problem, you don't know how big it's going to be, but you're used to handling that anyways. If that's a big issue for you, then another strategy that also really gets into this is basically doing call butterflies or call condors, where we buy call butterflies or we buy call condors. And we talked about this in our volatility playbook class. We do a lot with offset flies and offset condors. And by doing this, we can structure these where if we rally, we make money no matter what. Or if you want to go the opposite way, you can collect a lot more theta and know if you have your ass covered in case something crazy happens. You can pick. But by structuring these, what's great is you get the same type of behavior as you do with a targeted straddle. But the difference is that you know the maximum amount you can lose if the market gets crushed. So it puts you in a position that you know you can sleep at night. Your theta won't be as big. You won't collect as much theta. But if you get same thing, if you get where the market rallies slowly into your shorts, that can be a phenomenal strategy. So I think looking at these in indexes and looking at these in big cap stocks is going to be a fantastic way to play these over the next 3 months. Allow you to make a lot more money than other people are making by employing this.